Today, I'm going to tell you a story about the past decade, which has been a dramatic one for stock investors as equities rebounded from their crisis lows, put in dozens of new highs, and shrugged off all headwinds from debt crises abroad, three U.S. presidential elections, and multiple government shutdowns, a lengthy earnings recession that turned into record corporate profits. Is this story going to have a happy ending? Let's take a look. Stocks around the world have risen over the past decade, but the real story of the recovery is set on Wall Street. As shown in this chart here from FTSE Russell, while both US and overseas investors have made money over the past 10 years, the gains have been dramatically higher in the United States. The US recovery, aided by accommodative monetary policies, fueled a rally in which S&P 500 prices climbed by a factor of more than 4. For many investors, the past 10 years have been the story of large capitalization technology and internet companies, or the FANG stocks, that have been among the market's biggest gainers and boosts for years. These stocks have indeed seen huge rallies over the past decade, with one analyst dubbing the sector the greatest investment story ever told. However, the biggest companies haven't seen the biggest gains in the bull market. As this chart here from S&P Dow Jones Indices shows, small cap companies have led the move higher on a total return basis. The S&P 600 index of small cap stocks has easily outperformed the mid cap S&P 400, and that in turn outperformed large caps, with the S&P 500 the relative underperformer over the period. Central bank policy, particularly from the Federal Reserve, has been one of the primary drivers behind stock moves over the past decade. The Fed kept interest rates at rock bottom levels for years, and it also underwent multiple rounds of bond buying, which had the impact of making equities appear more attractive. This chart here from Morgan Stanley calculates financial conditions over the past 10 years. Fed policy is still seen as one of the primary ingredients in the investing environment, although it is increasingly cited as a potential risk as the central bank has removed and continues to remove some of the stimulative practices it implemented. J.P. Morgan recently wrote that the reversal of accommodative policy could result in the next financial crisis, while Morgan Stanley argued it could contribute to range-bound trading for years. Changing central bank policy is one of the reasons that investors are increasingly worried the economy could be in the late stage of its cycle, particularly with investor optimism at the kind of elevated levels that have historically presaged a recession. However, one measure of stock valuation suggests equities are not overstretched. According to J.P. Morgan Asset Management, and as shown by this chart here, the forward price to earnings ratio for the S&P 500 stands at 16.8. That's just slightly above its 25-year average of 16.1. So the story continues. And to follow this story, stick with me. For today, that's ChewDog Charts. Thank you.